All right, everybody. Hello. Elliot Katz here. It's 5 o'clock on the East Coast. Got a quick one for us today. Was out in Chicago over the weekend doing some live events. Really watching today, did a little day trading in the futures markets today. But going through the charts, starting to see a lot of charts that don't look very good. Maybe we're just going to be in a little corrective phase here. Maybe it's something more. As I was going through the weekly charts, I really only found maybe a dozen or so that I thought was worth looking into, and couldn't really find a trade. One of them right here you could see is Mosaic. We got a little breakout going here. I was somewhat pleased with what I saw in Disney. With this breakout right here, we are filling the gap, but the rest of the technicals are starting to look very good. Our old friend Tractor Supply. Remember, we had a trade on that earlier. It's one of our first trades. That's starting to look good as it's coming off of this little reversal here. But the thing that I'm finding is that the premiums just are not there. And since we're not really, there's Mondelez, since we're not really just buyers of options, looks like we might just have to wait around just a little bit. So we're going to keep working on the trades that we have on right now in the educational portfolio. Remember, these are trades for educational purposes, are only to show you how to use the principles that we teach in the course. So as of Friday, we've closed 22 trades. 18 of them have been profitable, 3 have been losers, and 1 has been what I call a scratch trade, basically zero. Of the 3 losers, one of them is Schlumberger, which is actually kind of a trade still in progress because we did turn it into a calendar spread right here. So I may have to adjust if we end up making money on this one, and the amount of money we make is more than we lost in the first go-round, we may actually turn that into a profitable sequence. But anyway, the average loss of 3 trades is only 8%, but the average gain of the 18 trades is 35.5%. This, again, proves that, well, I think anyway, can't guarantee, future performance or yada, 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 the whole deal. But I think it does show the power of this knowledge, the knowledge of option pricing behavior coupled with an understanding and an appreciation of the fact that stocks move through time, right? Some of the trades, if we put together and we post up some of the history of some of these trades, you'll probably see that there are going to be times during the life of a trade where things weren't looking so good. And a lot of times what you see is that we actually take the trade off for less than the initial cost of the trade, but because we've been able to use option premiums to lower the cost of the trade, we actually end up with a decent profit, like I said, on average almost 36%. And we've only been doing this since the beginning of July. So if you take July, August, September, October, right, that's 4 full months. We've closed out 22 trades in 4 months, let's say 4.5 months. So what does that mean? That we're doing about, what's 4.5 months? multiply that by whatever, 30, some 4.5 months, 4, 6, maybe 20 some odd. So on average, we're doing a trade a week. And on average, that trade is giving us, our winners are 36% and our losers are only 8%. So I think that's pretty good batting average. So what do we got? What did we do recently? On Friday, actually, I took off the trade in Suncor, and the reason, even though that Suncor trade, we were long the January 34 call and short the November 10 35 call, the stock actually got a little bit ahead of itself for us. You can see here today it's 36.30. Right up here, if you look up here in the left-hand corner. So unfortunately, there was not a good roll there. Now, the good thing about the trade, though, is that we started the trade on November 1st and we took it off on November 11th, which was the expiration Friday. So let me readjust that in here. That's actually should say the November. No, it was November 10th. Hold on. I didn't take it off on November 11th. I took it off on November 10th. It was the November 10th option. Anyway, we bought the spread. We bought the call diagonal spread for $1.10, and we sold it for $1.43. So, you know, we took that trade off. Now, let's see what we got going here. Okay, this AbbVie will be our first 100% loser, but our Whiting Petroleum is over a 100% winner. Okay, so far, even though the stock had a 1-for-4 reverse split, and in my live account, these strike prices have been adjusted properly. So this option is trading at about $1.20 right now. So that's a double going in there. So those things will cancel each other out from a performance standpoint. Okay. Couple of other things going on here. On Friday, this is one thing that you really should be aware of. We had this JD position on here where the stock was trading below our long strike price. Now it's a December 15 expiration, so we had plenty of time to work this one out. And coming into Friday, we were long the 40 call for December 15th and short the 39.5 call for November 10th. And we had gotten the cost of the trade down from $2.08 to $1.65 in the span of just a few weeks. We put the trade on originally on October 18th. So in the span of a very short period of time, we had taken out 42 cents. Now, earnings were scheduled, well, they did come out today before the opening, November 13th. And we all know that when earnings come out, when earnings are about to come out, implied volatility goes up. Now, implied volatility goes up not only for the options that are expiring the week of earnings, which in this case is November 17th, but they also go up for the week after, because the option market's smart. They know that people are going to say to themselves, hey, why should I buy this week's options? That earnings are coming out, I'll buy next week's options. Well, the volatility is going to go up in those too. Not as much as the week of earnings, but it was still going to be up there. And of course, once the event is passed, the implied volatility comes back down. So what I was able to do on Friday is I actually found a roll from our 39.5 call to a 42 call, which you see up there. And I actually got paid 30 cents for that. I actually got paid 30 cents for that roll. I bought back the 39.5 call for 58 cents, and I sold the November 24 42 call for 88 cents. I got 30 cents for that. That got the cost of the trade down to $1.35. Earnings were good, and the stock closed at 41.36. So now, as you can see right here, the mark on the trade is almost $1.80. Well, that's a 45-cent return on our original cost of $2.08. That's a 20%, over a 22% return, and we've still got a number of weeks to go. Now, we do have to wait. If we want to wait for this short 42 call to expire, we got to wait 2 weeks for it. But let's just say that the stock stays right where it is, right now. You can see that this thing is going to lose 58 cents, and this is going to lose about 2.5 cents a day over the next 11 days. So that'll lose maybe 40 cents. This option, the short, will lose 58 cents. So the spread will expand by 18 cents. And that'll get us to almost $2. Then we'll be up 65 cents on a $2.08 start. Now we're talking over 30%, which is right around our average. So by utilizing the higher implied volatility in the options, I was able to roll to a higher strike price, just in case the earnings were good, which they are. So, hang on one second. I got a memory error. Hold on. Hang on. I may have to close something down. Okay, we'll have to wait and see what happens. So I did not sell the call for this week, and the reason I didn't was even though the implied volatility for this week was higher than next week's, I wasn't able to get enough premium for the 42 call. In other words, I still had to have a lower strike price than 42. And just in case the earnings were going to be good, I wanted to give myself a high enough strike price so that I could have a nice cushion if the stock went up, which it did. If the stock went down, well, that's just the breaks. Okay, so that's where we are on that one, on that JD. Really happy about that. Another one on the Philip Morris just today. I'm sorry, on Friday, sold this 66 call for 20 cents. So we've got this trade down to $1.59, and it's trading for $1.86, and this January, so we got plenty of time for that one. And that chart is looking really, really good. Another one that's looking okay. I'll get to the ones that aren't looking that okay in a second. Well, I was pleased that the Yandex was coming back for us. Our cost on that is $2.45, so we got our work cut out for us. But this call is going to expire worthless right here, so we'll be able to collect more premium. Went over this one. This one, remember, we just converted into a calendar spread. Because we wanted to push this thing out, because the group, even though it's corrected a little bit, I guess maybe Saudi Arabia is not going to be a disaster the way most people thought, but we still want to have this calendar spread on because we only have 65 cents of risk in this trade. So really, it's very minimal. And we'll still get a couple of shots at collecting some extra premium. So the stock's backed off since we actually did this. The whole group has backed off a little bit. So we'll have to see how that comes out. Philip Morris, I did. JD, I did. This one, I'm disappointed on this. This Harley Davidson, the chart was looking good. Now the chart's looking really bad. We still have a month to go. The fortunate thing about this, and this is why you gotta love options, is our original cost was only $1, and now we're down to 51 cents. So we got a few weeks if we can suck out a few more bucks out of this. Hopefully we can get this down to a zero cost or a minimal loss. You know, where our batting average is way, way high. So remember, we got 18 wins, 1 scratch trade, and 3 losers. So we'll just have to wait on that. Okay, what are the 2 that are troublesome? Wait, did I do the Carnival Cruise? Did not do the Carnival Cruise. Carnival Cruise, thank God, its stock is starting to come back. On that trade, we're actually down to only 45 cents. We started at $2.05 on October 10th. And as of Friday, when I rolled the 67 call out to this Friday and collected another 25 cents, that got us down to a 45-cent cost. So with a expiration coming up next week, this $1.32 rise in the stock today got it close to 66. And let's see. Ooh, today's high was 66.02. So we can start getting this thing back up there. Actually be very, very pleased. Again, what we're trying to do with these losers is we just want to keep the loss to a minimum. The AbbVie is the exception to the rule. Exception because it just started going up right away. I did not react fast enough, and it just didn't make sense. I should have just taken the whole thing off, but it didn't make sense to start rolling the put strike up, because if the stock did reverse as quickly as it went up, we would have gotten whipsawed and it would have been a big, big problem. So, you know, if once every 6 months we have a 100% loser, it's not going to be the end of the world, as long as our batting average stays really, really high and our average gain is very, very respectable. Okay, so where do we have a problem here? This Costco, okay, there's only a couple of weeks left in this thing. Now, fortunately, we started off with a cost of $2.25 when the stock was $162.34. It was a bullish call diagonal. Now, this is one of those cases where the stock just started going up. I just kept rolling the 162.5 call for little bits of money, 36 cents one week, 80 cents another week, 40 cents last week. So we got the cost down to 69 cents, and right now the trade is worth about maybe 13 or maybe 10 cents. So, you know, this is going to be about, at worst, a 30% loss of our initial $2.25 capital. But we do have a little space here. You know, we got a little movement in the market here. Let's see what's going on here with the dividend. That's November 16th. Okay, so we should be okay on that. Now, I will say that in real life, we'd have to be a lot more careful with this short call here, because we got to be careful about an arbitrage against us in the dividend of 50 cents. So in real life, I'd be watching the puts here to see if this did not, basically to see if the 162.5 call had enough extrinsic value to cover the dividend. The arbitrage being that if you can buy this in the money call for less extrinsic value than the dividend, there's a possible arbitrage there. So with the stock at 171.50, right, this should be trading at $9. So it's trading at about $9. See, so it should have, right, what's 162.50 to 170, that's $9. So the mark on this actually is the intrinsic value. So right now, if tomorrow was the ex-dividend day, there would be a good chance that we'd get assigned on that, because the person who exercises the call gets the 50 today. If tomorrow is the ex-dividend date, they would actually be entitled to that 50-cent dividend. So there was the potential for an arbitrage there. I don't know what the offer was. So if the offer was above 9.5, if tomorrow is the ex-dividend date, we might not have to worry about it. But if there was enough open interest, there still could be the possibility of someone exercising that call against us. Okay, so that's something in the paper trading account that in the educational portfolio that we really don't have to worry about, because there is no real trade on the other side. But if you do have this trade on, be very, very careful about the upcoming dividend. My guess is that with the ex-dividend date on the 16th, you're more likely to be assigned on the options that are expiring this week than next week. But if there is not enough extrinsic value, there's still a chance that you're going to get assigned on it. Okay, so that's the Costco trade. The other one, and again, this is one that's going to be, unfortunately, a loser unless we get a big correction in the stock here, is we actually have this position on for a 41-cent credit right now. Okay, so we started with a $2.76 cost, and on Friday when I rolled into this 60 call, I actually now created a situation where we have a 41-cent credit. However, chances are I'm going to have to buy this back for $2.50. So we're actually going to have a $2.09 loss on a $276 original cost. So 209 on 276 is not going to be pretty. It's a 75% loss. So yikes. So that's not so great. AbbVie, not so great. Will be offset by the Whiting Petroleum. Everything else is actually looking pretty good. As I said, I am a little concerned that the charts of my weekly the charts of the stocks that have weekly options on them that I watch, things have either slowed down or some of the charts are actually looking like they've rolled over a little bit. So we got to be very, very careful here. Now, from our point of view, remember, if stocks start going down, all we're going to do is move our trades over to the put side. Use the same principles, but move it over to the put side. So with that, I'll wish everybody good trading the next couple of days, and I'll see you Wednesday at 5 o'clock New York time. Take care.